Let me describe two investors. The first one watched SpaceX go public on June 12th. They saved up, bought in at the IPO price of $135 a share, the largest IPO in capital markets history. They were excited. They told their friends. 2 months later, that same stock is trading around $108. That's down nearly 20% from the IPO price and down almost 50% from its post-IPO high of $225. The second investor didn't touch the IPO. Instead, they quietly invested in something most people overlooked. And not only do they already own SpaceX, they own the entire emerging ecosystem of companies that could benefit even more from what SpaceX started. Here's the part most people miss. The space economy isn't a SpaceX story, it's a sector story, and there's a much smarter way to own it without paying the IPO premium, without the lockout risk, and without betting everything on one company's valuation. Today, we're going to walk through exactly how. The IPO math. Let's start with something important. Before the IPO, I told you the SpaceX valuation was the real thing to watch, not whether SpaceX was a great company. It clearly is. The question was whether paying $1.77 trillion for it made sense on the day of the IPO. Here's the simplest way to look at it. SpaceX generated roughly $18 billion in annual revenue last year before the IPO. At $1.77 trillion, investors were paying about 98 times that revenue to buy in on day one. For context, most mature companies trade at 2 to 10 times revenue. Even the fastest growing tech names typically trade at 10 to 20 times. SpaceX was priced at nearly 100 times. That's not a company you're buying, that's a story you're funding. Now, does SpaceX have a legitimate path to justify that? Yes, actually. In Q2 2026, SpaceX reported revenue of $7.8 billion, up 92% year over year. The AI compute business alone surged 247%. Management projects a $100 billion annualized revenue run rate by end of 2026. These are real numbers. But here's what history consistently tells us about mega IPOs. The Ritter studies on IPO performance show that the average IPO underperforms the broad market by roughly 17 percentage points in the first 12 months, and the bigger the IPO, the more volatility follows. Alibaba, the previous record holder for the largest US IPO, came public in 2014 at $68, surged to $93 on day one, then drifted lower for nearly 3 years before reclaiming its IPO price. SpaceX followed almost exactly the same pattern. It opened at $135, hit $161 on day one, touched $225 intraday within the first week, then fell sharply. It traded as low as $108 earlier this month before recently recovering back above its IPO price. That's not a reason to write off SpaceX forever. Revenue is doubling. The AI compute business is growing at triple digits. Multiple analysts have revised their targets upward after Q2 earnings. This company is real. But here's the investor's dilemma. Paying the right price for a great company matters almost as much as finding the company in the first place. Micron returned over 670% in just 12 months last year, and nobody was talking about that on IPO day. So what's the smarter move for someone who believes in the space economy but isn't willing to accept IPO-level risk? ETF number 1, XOVR. The first ETF is ticker XOVR, the ER Shares Private Public Crossover ETF. XOVR has a unique story. It's notable for being, to its own knowledge, the first US-listed ETF to hold SpaceX while it was still private and to continue holding it as a public company post-IPO. It held Klarna before that IPO too. The fund is specifically designed to provide access to the pre-IPO economy through a standard brokerage account. No accreditation requirements, no minimums, daily liquidity. SpaceX was its largest private holding, and the rest of the portfolio is concentrated in large-cap public innovators, NVIDIA, Google, Meta. So you're getting a blend, the public market's best-known tech companies alongside emerging private names the broader market can't easily access. One honest caution on XOVR: because it now holds SpaceX as a public company, part of what made it unique, the pre-IPO edge, has shifted. As SpaceX gets added to major indexes, that differentiation matters less. That said, the fund continues to search for the next crossover candidates, which is its core mandate. The expense ratio is worth verifying before you buy. Earlier filings cited a net ratio around 0.75% with a gross ratio closer to 1.8%. The difference reflects fee waivers that expire. XOVR is best suited for someone who wants a mixed private-public portfolio and likes the idea of getting into the next SpaceX before it goes public. ETF number 2 is ticker NASA, the TEMA Space Innovators ETF. This one launched on March 30th, 2026, and the early data is striking. Within roughly 6 weeks of launch, NASA had gathered over $400 million in assets, one of the fastest ramps any space thematic ETF has seen. What made it stand out immediately was its SpaceX positioning. TEMA holds SpaceX as its top or second largest position at roughly 20% of the fund, the maximum allowed under standard ETF concentration rules for a single holding. That's more SpaceX exposure than any other publicly traded ETF. But here's why I think NASA is more interesting than just a SpaceX wrapper. The rest of the portfolio is genuinely space-focused. Rocket Lab at around 11%, AST Space Mobile, Planet Labs, Viasat, and Intuitive Machines. These are companies actually operating in orbit or enabling others to do so. Rocket Lab alone is up 58% over the past 12 months, with Q2 revenue growing 62% year over year and a $2.4 billion backlog. AST Space Mobile, the company trying to beam satellite internet directly to your phone, is up over 300% in the past year. So when you buy NASA, you're getting concentrated exposure to the space sector, not just as a SpaceX trade. The expense ratio is 0.87%, higher than most broad market ETFs. That's the honest cost of an actively managed, specialist fund in an emerging sector. Whether the performance justifies it is the right question to ask. Since inception, NASA is up roughly 37%, comfortably outperforming the S&P 500 in the same window. This ETF is best suited for someone who wants maximum pure-play space exposure and is comfortable with the concentration and volatility that comes with it. ETF number 3 is ticker ARX, ARX Space Exploration and Innovation ETF. This one has been around since March 2021, which means it's the most tested of the three. And over the past 12 months, ARX has returned approximately 64%, outperforming the S&P 500 by a meaningful margin. What makes ARX different from the others is its philosophy. Rather than trying to concentrate on SpaceX and hope the valuation works out, ARX is structured around the entire supply chain of the space economy. Cathie Wood's team describes it as the convergence of space technology, defense innovation, robotics, and AI hardware. Top holdings include Rocket Lab, L3 Harris Technologies, Kratos Defense and Security, AMD, and Palantir. SpaceX is a position at roughly 9%, but it's not the thesis, it's one piece of it. The fund owns the companies building the chips, sensors, software, launch services, and communications infrastructure that every other space company depends on. That's the picks and shovels logic. Whoever wins the space race, they'll all need Electron rockets from Rocket Lab, defense electronics from L3 Harris, and processing hardware from companies like AMD. The expense ratio is 0.75%, and with nearly $900 million in assets under management, this is the most liquid and established of the three space-focused ETFs we're discussing. One honest trade-off: ARX is more volatile than a broad market ETF. Its top 10 holdings account for roughly 57% of the fund, and it leans heavily towards industrials and defense-adjacent technology. If you're someone who needs stability, this probably isn't your core holding, it's a satellite position. But if you believe the space economy is going to grow from $630 billion today to over $1 trillion by 2030, ARKS gives you diversified exposure across every layer of that growth without having to pick the single winner. Before you buy any of these, here's something worth knowing. If you own Alphabet, Google's parent company, you already have significant indirect SpaceX exposure. In its Q2 2026 filing, Alphabet disclosed that its SpaceX stake is now worth $94.1 billion. That traces back to a 2015 investment of roughly $900 million, which has returned about 100x. The entire position remains locked up for now due to post-IPO restrictions, but it represents one of the most profitable venture bets in Silicon Valley history. The relationship goes further. Alphabet also signed a multi-year contract to pay SpaceX roughly $920 million per month for AI computing capacity, running from October 2026 through June 2029, totaling approximately $30 billion. That agreement grants Google access to around 110,000 NVIDIA GPUs housed in SpaceX's data centers to support Gemini and other AI products. If you own the Fidelity Contra Fund FCNTX inside a 401k, you've also been long SpaceX for years, with SpaceX making up roughly 5% of that fund's holdings. This doesn't mean you need to rush out and buy more exposure. It just means the FOMO of missing the SpaceX IPO may be smaller than you think. Here's the perspective I want to leave you with. When a company goes public at $1.77 trillion and then drops